There's really not much of a debt gap anymore. I mean, the investors have come from, the U.S., Asia. Obviously, in Europe, we've built up the more senior debt funds. We've got a lot more banks returning that have been able to resolve a bit of their difficult solutions, primarily because real estate has now increased in value. So some of the situations where their loans may have not been performing or were subperforming are now back to performing. So there's an increase appetite for lending on real estate. So there really isn't as much of a gap anymore. In fact, there's, when you start to consider how much margins have compressed really in the last 15 months, primarily, shows you that there's a lot of liquidity out there. There's, we're not back to 40 banks bidding on a deal, but there's definitely, 4 or 5 for every deal. And back in 2012, there might have been 2. So you're seeing a lot more competition by number of banks, but also more competition as far as the spreads that are coming in.
Well, I'd echo Paul's comments around the return of liquidity to the market, and certainly more competition on prime deals and margin compression in that segment of the market. We're still seeing some situations where deals aren't readily refinanceable, so there is a role for lenders to plug a gap between where the senior loan bid is and where the refinancing proceeds need to be to make a deal happen. So there is a role in that sense for either stretched senior or whole loan providers who can go up to a certain LTV level, or indeed mezzanine players. Property is an extremely varied sector, which makes it so much fun for all of us to work in. Every deal is different, so some lenders might not want to do certain locations, certain property types, underwrite certain business plans, and that's reflected, I think, in the level of competition or lack thereof for given deals.